Welcome back everyone to the last video on professional conduct, where we look at the Code of Professional Conduct for SICA and IRBA as well as the IFAC code. This is the third video in this series. It's also the last video in this series. If you haven't watched the previous two videos, I would encourage you to have a look at them. Remember, in video 1 we went through what exactly part 1 entails with the fundamental principles, the threats to the fundamental principles, and just very basically how to develop and evaluate safeguards. In video 2 we looked at part 2 and part 3 of the Code of Professional Conduct, where we looked at chartered accountants or professional accountants in business and in public practice. In this video we're going to be looking at part 4 of the Code of Professional Conduct and how it relates to both auditors in public practice as well as those in business. This part of the code is actually going to be done by way of example. So there are going to be a lot of examples that we're going to go through. We're going to discuss each of the different types of principles, and we're going to look at them individually with the use of examples. And then finally, we're going to finish off by changing gears and looking a little bit at the IRBA code, particularly the rules on improper conduct. Now, we said in video 1 there's 17 rules that are very particular to the IRBA code, so you won't find them in the SICA code, and that's what we're going to look at today. Okay, so let's get started. So the first idea that we need to tackle is independence. What is independence? Well, the code tells us there are two types of independence. There's independence of mind and independence of appearance. Let's look at independence of mind. Independence of mind means that the professional accountant acts in a way that is free from influence. He is able to exercise his professional judgment as well as his professional skepticism, free from bias. This means that there is no influences or bias or pressures placed on him when he comes to his conclusion. So he is free from any influence. When we look at independence of appearance, this is only dealing with the external view of the accountant. So basically, is the accountant viewed as being independent? Does a reasonable third party, knowing all the information that is available, will that third party conclude that the professional accountant is acting in a way that is unbiased and objective? Now, it's very interesting. Why do we need to have independence of mind and independence of appearance? Well, independence of mind means that the accountant actually acts in a way that is independent. So this is the basis of independence. Are you really independent? For me, this is the most important type of independence. Independence of mind is critical because without independence of mind, the decisions that are reached will not be objective, nor will they be independent. But because chartered accountants as well as auditors work for the benefit of the public, and we spoke about public interest in the first video, and we said that without the public's trust being in accountants, the accounting profession will fall because we work for the benefit of the public. So if the public is unable to trust us, then our word is no more credible, our opinion no more matters, and therefore we don't have a job. So therefore, independence of mind helps us to arrive at an independent conclusion. Independence of appearance means that that conclusion actually holds weight and is credible in the eyes of the public. This is why we need both. Loss of either type of independence will mean that we are unable to do the job that we were asked to do. So the first principle that we're going to look at is financial interest in the audit client. Now, if an auditor or the close family member of an auditor holds a direct or indirect interest in the audit client, this means that he will not be viewed as independent. So he will lose his independence of appearance. In addition, it may affect his independence of mind because he will be acting not for the interest of his audit client, but in his self-interest. This creates a self-interest threat. Notice how I said it depends on whether the accountant or the auditor, as well as his close family member or friend. This will extend to even mean juristic persons. When I say juristic persons, I mean those persons that are companies, those persons that are trusts, and those persons that are firms. So basically, any person that is created by an act of law. In addition, we said that the interest can be direct or indirect. This may mean that you, as the auditor, need to investigate the weight of a specific financial interest before you determine if it is direct or indirect. Normally, indirect interests are very hard to determine, so you may need to spend extra time in analyzing such interests. Another thing that's important to note is that the interest must be material. So it must be of an amount or of a value that would change one's economic decisions and would affect the accountant's judgment. If the interest is too small, then it is not considered to be a threat. When we're looking specifically at the family member of an auditor and their interest in the audit client, we want to try and consider the nature of the relationship between the auditor and members of the audit team. Also, the materiality of that particular financial interest to the close family member. Notice how when the family member is involved, we look at it from the viewpoint of the family member and no more from the viewpoint of the auditor. And finally, we want to try and identify the significance or influence that this particular family member has upon the auditor. So, by way of example, if an individual who has a close personal relationship with a member of the audit team, for example, a best friend, has a direct or material indirect interest in the audit client, what types of threats would that create? Well, that would create a self-interest threat because the close personal relationship or close personal family member of the auditor is going to gain some sort of benefit. The next thing is it will create some sort of familiarity threat because this person will now become more sympathetic to the plight of their audit client. What types of safeguards would one put in place? The first thing is that they want to notify the audit client, and particularly those charged with governance, such as the audit committee or board of directors, of the existence of this financial interest. Also, they may want to provide additional independent review of the work done by this member, as it particularly relates to the relationship of the close family member. They may even consider removing this family member off the audit. Or they may just limit their decision-making power with regard to the audit, so that this person does not make material decisions in the audit. When I talk about material decisions of the audit, I'm talking about things like the audit plan or audit strategy, what materiality is determined to be, what areas of focus we have in the audit, etc. Let's move on to the next principle of loans and guarantees. So we have a situation where a loan or guarantee is made from the audit client to a member of the audit firm. Is this a threat? Now, many of you will say, yes, of course this is a threat. But we need to dig deeper and understand if the loan terms are normal loan terms or arm's length loan terms, or are they not? If the audit client is actually a financial institute or not. For example, if we're dealing with an audit client that is a bank and they issue a loan to someone who is on the audit team at normal or arm's length loan terms, this does not pose any risk. There are no threats that are created because the terms of the loan are normal. The only risk that we have and the only thing that we want to look at is the materiality of such a loan to the audit team in total. In addition, we want to also analyze the decision-making power of that audit member. But if all things are held equal, this does not create any significant threats. However, if we are dealing with a situation where our audit client is not a financial institute, then we need to be very careful about why our audit client is giving a loan to a member of the audit team. Now, in the rare case where we have a company that is not a financial institute and issues a loan that is not at arm's length to a member or a close family member of the audit team, this creates a self-interest threat. The loan should be cancelled and repaid immediately. If it is immaterial to both parties, then the audit team can apply a different safeguard. Let's move on to business relationships. When we talk about business relationships, we are particularly excluding family and friends. We are saying that there is a relationship that relates to the doing of some business. For example, if a member of the audit team and a member of the client enter into a close business relationship, maybe opening a restaurant together or come to an agreement to start a joint venture, this can create multiple threats. For example, self-interest threat, intimidation threat, and familiarity threats. What would the auditor need to do? Well, the auditor would have to really consider terminating the business relationship or the audit engagement. This would reduce the magnitude of the relationship and therefore reduce the financial interest to an immaterial level. If the member who is involved in the business relationship is not a key member of the audit team, the audit partner may consider removing this person or even allowing this person to continue but having an independent review of their work. What is important to note is that if we are dealing with a retail audit client, so for example a ShopRite or a Checkers, and if someone or many people from the audit team purchase from this retailer, this does not create a threat because from the purpose of the retailer, the purchases made are not material and it is in the normal course of business that the retailer has sold to the audit team. The key point here being normal course of business or arm's length transactions. If the transactions are not arm's length, then we will need to interrogate it more. Next, we're going to look at family and personal relationship. If the client has a close family relationship to someone at the audit team, what sort of threats does it create? Well, it creates the threats of self-interest, familiarity, or even intimidation. It may even, under some circumstances, create advocacy threats. The member of the audit team, if they are not critical to the audit, should be removed. And if that member is critical to the audit, then the audit firm should consider removing themselves as auditors or declining the engagement. Also note that if this person is not a key decision maker in the audit team, you can allow this person to continue and have an independent review of their work. 3 relations away means that we need to look at jumping 3 different people. For example, we have an audit team member who has a mother who then has a friend. That is 3 jumps. 1, the audit team member, then the mother, then the friend. That person is still considered to be a close or personal relationship. But when we go 4 or more, then we consider this not to be a close relationship. Notice also what's important is that the level or influence that the conflicted member has is very important. If they're a junior staff member at the audit team, very minimal safeguards is required. But as they become more and more important to the audit team, we need more safeguards until the point where they are the partner or the manager, and we may need to decline the audit entirely. So for your purposes in tests and exams, just note that if there's a close family relationship, it automatically gives rise to 3 different threats. That is self-interest threat, familiarity threat, and intimidation threat. Next, we want to look at employment at an audit client. If a member of the audit team is promised employment in the future or will be currently employed, there are different types of risks that can be created. For example, if someone is promised employment in the future, it does create a familiarity, intimidation, and self-interest threat. But if someone who was previously on the audit team now becomes the audit client, it creates a lot more familiarity and intimidation threat than it does self-interest. So we need to be careful when someone in the audit team is offered employment or takes up employment at the audit client. What can the auditor do in order to mitigate the risks? Well, the auditor can introduce changes or unpredictability to the audit strategy and audit plan. They can assign more experienced team members to the audit, and they can introduce additional reviews to ensure that the audit team remains objective. In addition, they can create policies and procedures for the staff members around when they can accept employment and when they can't. They may even need to remove some members of the audit team. Temporary staff assignments at the audit client. Now, under some circumstances, some members of the audit team may be seconded to do work at the audit client. This creates a self-review threat. Why? Because that member may be doing a piece of work or a portion of work that is later audited by themselves. What sort of safeguards can we implement? We can ensure that the person that is seconded to the audit client is accurately managed, that they are either removed from the audit team if they are too senior, or that they are only given portions of the audit that they have not been involved in at the client. Recent service at an audit client is actually the opposite of employment with an audit client. Remember, with employment at the audit client, someone from the audit team was offered employment at the audit client. Whereas recent service at the audit client, we have someone from the audit client now coming onto the audit team. So it's the opposite. When we're looking at that sort of case, we want to try and understand the position that this person held at the audit client, the length of time that they were there, and the role that they now fulfill on the audit team. This does create a self-interest, self-review, and familiarity threat. If the threat is perceived to be significant, we can prevent this person from being involved in the audit. We can introduce an additional review of the work of this person, and we can notify the governing body or those charged with governance. Very similar to that is serving as a director or an officer for the audit client. It's almost the exact same as recent service at the audit client. Just now we are dealing with someone in leadership. If we have someone on the audit team that used to be someone in leadership at the audit client, we should withdraw or resign from this engagement because the threat is far too significant. It would include self-review, self-interest, self-review, self-interest, familiarity, advocacy, and even intimidation. Long association of senior personnel at the audit client. This is where senior personnel at the audit client have a long ongoing relationship with senior personnel on the audit team. What can we do? Well, we can change the audit personnel or the audit team. We can introduce an additional level of review. We can have additional quality control reviews. However, the threat here is quite a significant threat, and we need to be very careful how we address this. Because remember, there are familiarity threats, there may be self-review threats, and there are even self-interest threats. Remember, when you are dealing with this type of case, we need to look at Section 92 of the Companies Act. We will deal with that in more detail later on. This one is quite a key one for many auditors, the provision of non-assurance services at the audit client. This means that the auditor is providing other sort of services that are not assurance or audit related to the audit client. This is a very big threat because it creates self-interest, self-review, and advocacy threat. And in the past, we've seen major breaches of confidentiality as well as professional behavior because of this type of threat. What should the auditor do? Well, the auditor should not allow themselves to render additional non-assurance services to the audit client because the threat is just too big. They need to develop a policy that conveys that all audit teams and those in the firm involved in formulating or being involved in non-assurance services should not be included on the audit. This will include the preparation of accounting records. Because remember, as the auditor, you never want to prepare the financial statements and then audit it. That creates a self-review threat. So part of the services that we are now talking about are accounting services. If we have a case where someone has prepared the financial statements and is now going to review it, we need to firstly look at the level or influence that this person may have, and how was the non-audit work approved? Were those charged with governance notified? For a private firm or private company in South Africa, the onus or the burden is a lot less, because we can have a situation where the auditor prepares the financial statements and then audits it only if the person that has prepared the financial statements is not included as the audit team but may be employed by the audit firm, and if they notify the audit team that all decisions that are made in terms of the financial statements are made by management and are not made by the audit firm. They clarify that it's management's responsibility to source accurate data and transaction approval to make sure that journal entries are accurately orientated and approved, etc. Another type of service that may be offered is valuation services. This is where a professional may value a company or a share that wants to be purchased by the audit client. When we are dealing with this, we need to be very careful that we do not slant the valuation toward a specific goal. So if we want the price to go up, we can easily slant the valuation to create the impression that the company is more valuable than it actually is. So we need to be very careful about that. It does create a self-interest and self-review threat for an auditor or a professional accountant. We can ensure that the person that is performing the evaluation is not included at all in any other services that may be offered to the audit client, and that the work of valuation is actually reviewed independently by a third party. What happens if we prepare tax services for the client or tax returns for the client? This does create a self-interest threat, but there's a fine line to be understood here. So from the perspective of an auditor, the audit team can help in the preparation and allocation of figures into e-filing. So if all the calculations have already been done by the client, we can assist the client by indicating to them how to fill out the e-filing form. We may even assist with certain queries that SARS has on the return. However, we must not be involved in the calculation of the current and deferred tax liabilities, because this will create self-review threats. We can also not be involved in planning and advising on tax strategies or tax planning. Furthermore, our audit firm should never represent our audit client in order to resolve a tax dispute with SARS, because this will create advocacy threat. What happens if we supply internal audit services to our audit client? Well, that would create a self-review threat. Providing internal audit services such as setting the internal audit policy, strategic direction for the internal audit team, directing and taking responsibility for internal audit employees, deciding on recommendations that the internal audit makes or implements, performing procedures such as business risk assessments on behalf of the internal audit, all create self-review threats. What should the auditor do? The auditor should be very careful with regard to the Companies Act, because it may be illegal for the auditor to offer such services. In addition, it may be contrary to what King 4 requires of them. The best safeguard is not to offer any internal audit services if you are the external auditor. However, the code does state that an external auditor can offer some audit services, but must always avoid assuming responsibility for something that management needs to do, such as reviews or evaluating of the internal audit. These are all things that the governing body must do, and the external auditor should not be involved in it. What about IT services? Performing IT services such as designing and implementation of internal controls can create self-review threats. What should the auditor do? So if it's a private company, the auditor needs to ensure that management acknowledges the responsibility for the work that is performed. They need to ensure that the management of the client delegates internal controls to competent people. And they need to ensure that anyone that was involved in creating the internal controls are not included on the audit team. Now that's for a private firm. What about a public firm? Well, For a public firm, there is no safeguard. So this should not happen if your client is a public client. What about legal services? It can create a self-review threat if we're involved in assisting the client in a litigation. What should we do? We should use professionals in the firm that are not part of the audit team. We should have independent experts. We should ensure that the audit client takes responsibility for all decisions made with regard to the litigation. Legal services are treated very much the same as litigation support. The only difference is that we need to ensure that we cover advocacy threat as well. What happens if we are involved in recruiting of senior management on the audit client's behalf? This can create a familiarity or self-interest threat. What do we need to do? We need to limit the service to reviewing suitable candidates only. That means we don't recommend any candidates, we just assist them with reviewing or analyzing the credentials of the candidate. We leave the final decision up to the board. Corporate finance services can create self-interest threats as well as self-review threats, including advocacy at times. What do we need to do? We need to ensure that management takes responsibility for all decisions and approves all decisions that are made. We should always have audit team members that were not involved in rendering the corporate finance services. Fees. When we look at fees, we want to try and understand the relative size of fees in relation to our audit client versus other audit clients that we have. So what percentage of audit fees are we getting from an individual client? We want to identify if there's a dependence on one specific client. This can create intimidation and self-interest threats. We need to always ensure, as a safeguard, that we have multiple clients and no one client becomes a major client of the audit firm, thus limiting the amount of dependence we have. We also need to ensure that we have external quality reviews on the work that we perform for larger clients. If fees are overdue, and if our audit client has not paid us a specific amount of fees, this can also create a self-interest threat. We want to ensure that we obtain partial payment of fees before any further work is completed. And we have additional independence reviews on the work that we perform. Remember we spoke about contingent fees? Well, contingent fees also are a problem here. We want to ensure that everyone understands that we are receiving a contingent fee, particularly those charged with governance. We want to make sure that the contingent fees are fair if we receive them, but you must still note that contingent fees for auditors should not be accepted. However, it may be accepted by the audit firm if it is received by another department of the same audit firm. If the audit team members are given a financial bonus for selling non-audit services to the audit client, that can create a self-interest threat. What do we need to do? Well, we need to eliminate the compensation that they receive or the remuneration that they receive. We need to remove the audit team member from the audit. And we need to ensure that if the audit team member has already done work, their work is reviewed independently. Finally, gifts and hospitality, we have already spoke about at length. You know that it can create a self-interest, familiarity, and intimidation threat. We should not be accepting any gifts that are too material for either ourselves or our audit clients. What about litigation? If our audit client threatens us with litigation, this may create self-interest or intimidation threats. In this situation, it is almost impossible for the auditor to do their work or to apply audit standards. As a result, the auditor should withdraw from the audit engagement. This should only be determined after a negotiation with the audit committee. So now let's change gears and look at the rules on improper conduct. I've broken up the rules into 5 different areas. The first area that we're going to look at is failure to comply. If we have an external auditor that fails to comply with either the Auditing Professions Act, with any other act promulgated by the government, with any prescribed pronouncement that URBA issues, or would in fact the URBA code, they would be liable for misconduct. Remember, when an auditor is liable for misconduct, they can either be given a reprimand, means that they're given a formal letter in which they're told to stop doing what they're doing. They may be given a fine, or what we found more recently is that their registration with URBA is cancelled and they are removed as an official member of URBA. This means that they can no more practice. So this is very serious. The next section that we're going to look at is dishonesty. If someone is dishonest, what does that mean? Well, they have engaged in theft, fraud, perjury, bribery, or corruption. They may be involved in some sort of dishonesty when they're carrying out their work duties, or they may be involved in dishonesty as a result of their position or office. Failure to perform a service that is reasonably expected from someone with this type of skill is also dishonest, and evasion of tax, duties, levies, or any rates is also considered to be dishonest. If the external auditor offers an audit opinion on future estimates, this is considered to be improper because the auditor does not have any solid data to back up their opinion. We can also have certain dishonest or improper conduct that relates to audit training. If we place a restriction on the audit trainees in terms of what employment they may receive, if we attempt to cancel the audit trainees' contract without notice or to limit their pay, if we have any other kind of non-compliance, or indeed if our audit trainee does not comply with the code, if we fail to communicate timeously with URBA regarding these things, we can also be found of misconduct, or if we fail to pay URBA's fees. What about if we plan to resign? Well, if we plan to resign and we don't give our audit client reasonable notice, this is considered abandoning the client, and we can also bring the profession into disrepute because of that. As a result, we will be considered to have acted improperly. These are the 17 rules for improper conduct. We have just summarized them into 5 broad areas on the slide. Okay, thank you guys. So that's the end of professional conduct. Join me next time when we will be looking in depth at another part of auditing.